the market came down and broke and attempted to break some very important technical areas. But the one thing that stood out, the YWM, which we've been speaking about, from under 200, went to 225, and then 225 down to 220, 218, 216, tried to move up again, a lower high, and then came back to the 218 area, and now it's off to the races. The IWM is the darling of the investment community in general. And that is the reason why is, I don't know, it used to be very accurate, but, up to this day, the IWM, 37% of the stocks in the IWM, don't quote me exactly on that because it's changed in the last 2 weeks, but around 37% of the companies do not make money. But what they do have is hope. They have hope. And hope generates positive vibes. They are raising money. They may do a secondary stocks like that. They tend to spend more of the cash they have on hand in research and development because that's what they have to depend on. So, they're not growth names, but some of those names within that IWM are going to turn into growth names because they're going to hit on some of these things, and some of the things that they're working on, whatever it is. So that's why you're getting a community piling in on the IWM. And, it's a good thing. It's a real good thing. Conversely speaking, when the market came down and started hitting levels, the financials were still holding up. And the financials are now, we spoke again about the IWM a number of weeks ago, and I continue to speak about it during my sessions. But I think you have the financials in that same vein right now. The regional banks are breaking out. That would be the KRE index. That would be reflected in the KRE index and the XLF index. Now, those are very important to me at this juncture of the market. They refused to come in, and the market eventually gathered itself and followed. Yesterday was a wake-up call in the afternoon where they just pulled the plug. And, out of nowhere, this is dangerous stuff. Out of nowhere, just pulled the plug and shook everybody out. Why do the algorithms shake everybody out? Well, they want clear sailing ahead to do what they do. And that's why they do it.
Was it the part of consolidation or historical sell-off during this period?
Say that again. I'm sorry, Barris.
Was it part of the consolidation of the Magnificent Seven or historical sell-off during this period?
Well, there's a tremendous rotation going on here. And I look at it like there's a pool of money, and that pool of money gets distributed. Inflows come into the funds, outflows go out, but the pool of money usually stays consistent. It gets changed by the inflows and outflows, all right? And there's no outflows right here for the most part. So what you're seeing is a rotation within certain sectors of the market. All right. And that's why you see the IWM come on like that. And now you're seeing the regional banks that have been acting well for a number of days or maybe even a couple of weeks. Now you're seeing that sector, which is the biggest sector. The financial sector is the biggest sector of the Dow Jones Industrial Average. So, now you got everybody participating, and the theory or what you're looking at here, or the possibility of what you're looking at, is a market that is bottomed. And so you see hope. There's hope. There's hope on betting on companies that don't make money that will hit with their research and development and hit on a very big aspect of their business. So you're seeing money go to that, and let me just take a quick look.
Yeah, sure.
Wow. The market just puked like 30 or 40 handles on the NASDAQ. ES contract was 26. It's 98. I mean, this is dangerous stuff, okay? Dangerous. Really dangerous.
So you mentioned about hope. Is that kind of hope that triggers any upward trend, or is that the hope kind of kills people?
You know, I mean, you talk about psychological effects. Hope kills people too. Too much hope kills people. There's more problems that could take place when you're betting on hope. There's more gambling involved by the players in the marketplace gambling on hope. So you see divergences take place on a much more consistent basis, and you also see a level-to-level style of trading, which is conducive to day trading. Doesn't make it any easier. You know, you just look for ways where you could have a mathematical advantage. That's all any trader to do, no matter what you're trading. You need to have a plan. You need to have an idea of what your game plan is and how you want to attack it. You can't just, go all in. You just can't. You could get lucky doing that, but getting lucky doing that when you don't have a plan could come back and bite you. Because if you get overconfident in that particular style, you're going to get burned and you're not going to make money.
That's a key takeaway, actually. If we go back to our topic for today, Richie, I would like to ask you, what are the most common psychological challenges that traders face and how they impact trading performance?
There's always that voice in your head. When you have that voice in your head saying, what am I going to, should I be buying here? It looks beautiful. It looks like it's level. It looks great. The patterns that you see setting up, you're comfortable with. You've done your homework. You've done your due diligence, and it's spitting out a buy. But there's that voice in your head that says, no, let me wait. Listen, if you can look in a mirror, all right, and if you can look in a mirror and know you've put in your time, and you have to continue to put in your time. This is not a one-off type situation here. This is not a sprint. This is a marathon. And even at this stage of the game for me, I still learn every day. I still make adjustments. You have to continue to make adjustments. And a lot of it is psychological, okay? A lot of it. And you need to know your personality first and foremost. Because if you do something that's outside of your personality, you're going to make a mess out of your trading. All right. I don't care, if you're not a long range player and you can't sit there, and take a trade when they give it to you, looking for the double or triple, and you don't take that trade and it comes down in your face, all of a sudden it comes down. Well, that prevents you from looking at the next trade. Okay. And it prevents you from putting money in the bank. Yeah. Is the upside, can you listen? The perfect scenario that everybody wants to be in is that you have an entry, you make your choice, you're long, whatever you're long, up, you stop, follows it up. It's all beautiful. Total meltdown in the market behind me. My partner's just saying what I just mentioned. The total meltdown. This happened yesterday afternoon too. These people, you have to think of this market. We talk about psychology. A big part of my life is spent on figuring out. I don't want to say, I want to be careful here. A big part of my life is to figure out what the other couples are trying to do. Okay, what the investors are trying to do, and to me, I view it as criminal activity. Even though I don't think everybody's a criminal out there. Everybody hear that? Compliance. I don't think everybody's a criminal, but I do think that it's a contrived effort to fool everybody. It's a combined effort to trap traders, trap them in bad positions so they could take the other side. It's just, you need to track them like a detective. Okay, you need to track criminals like a detective would. This is a better way to put it. Like a detective would track criminals. That's what you need to do. You need to put yourself in their position. You need to think that they're always trying to hurt you. They're always trying to trap you. Okay, if I see the parameters that I look at and the charts that I'm looking at, and I see them going against the grain, and I see a discount area or a premium area on my charts, and it gets close to those charts, and it gets close to that premium area or a resistance area or a discount area, meaning a support area, and I see the market firming up on the way down, approaching a significant support area, and I see it, and all of a sudden, on a quick flip, boom, they come down to that discount window immediately. What are they designed to do? Designed to get you to sell your longs, designed to get you to short the market, okay? Why? So that it's cleared on the way up. And you'll see that a lot. If you look at a bar chart, okay, and you see, and they're not tight to one another, all of a sudden you see an area where there's a distance, there's a space between the bars. And if the space between the bars is on the down bars, well, that means there are algorithms piling in there to do the same thing, and vice versa on the way up. Those are just little perks right there, psychological stuff. Albert Cologne, hello.
Hi, Albert. Good afternoon. Do you think that's done by purpose by the hedge funds, or I don't know, politics, or what's the reason, or is it just settled there to, as you said, to on the way back, more margin to buy there?
Look, algorithms are not human. They are programmed by humans, no matter what anybody tells you. This is a huge market, especially with the day trading of options that expire at the day. You're talking about, when you have the amount of money and the size of the positions that these deep-pocketed funds have, okay, they have to hedge. There's no such thing as buy and hold when you're long 30, 40 million shares of a stock. They're not just sitting there with them like the old days. They have to hedge some of that position. Or they have to answer to somebody above as well. And that's not a pleasant conversation to have if you're sitting long the Magnificent Seven and they sell them down 10 or 12% and you didn't hedge any of that position off, you're going to get called on a carpet. So the option market in this day and age shows you areas, and it shows you areas where the strike prices lie. Okay, for instance, Tesla the other day had a 9% probability of moving either way. Google had a 7.5 to 8%. Either way. Where did that come from? It comes from options. It shows you where the action is on the strike prices. And it's able to predict. It doesn't say it's a 9% up probability. It says up or down. So there's going to be movement. And so where did Tesla go on? It went down almost 9% right to the freaking tick. Where did Google go? Almost 7.5%, 8% right to the tick. Okay? That shows you how much the options have to do with everything. All right? And that's why some of the numbers that you see them spitting out here, okay, whether it be on an earnings report, whatever it is, some of these numbers are so locked in because there are other things that are predicated on the way these stocks move now, i.e. options, difference of opinion.
How can traders develop a mindset of disciplined trading mindset, especially in the face of market volatility and unexpected events we have currently?
I mean, you have to really focus on what you're doing here. This is no joke, folks. You have to focus on what you're doing, and you have to be very patient on how you go about it. Psychologically, this could hurt you. It could hurt you. But, you need to protect yourself on all your positions, no matter what. The first thing you have to do before you buy or sell or initiate a position, you have to know what you're willing to risk on that position. And then you have to, by knowing that, then you can identify just, where you want to put your stop. if you're in a major technical area on a way up, like this nosebleed territory that the YM, or I call it the dirty Dow, nosebleed up 400-500 handles. Okay, now I see that, and I know that there's a major technical resistance area on a ES contract, nosebleed territory. So so in a situation like that, if I want to take a short, and I think that it's going to be, it plays into it. Why? Because if they're going to spend more money after it's up 400 or 500 handles, okay, from that point, and I know there's a technical resistance area right there as well, okay, I could short anything right there, but I could keep it tight because I know that they mean business, that they're going to take it higher than that. And so in a situation like that, I'm not willing to risk a lot. I'm willing to risk only a little because I know they mean business if they're going to go to this area after being up 400 or 500 handles. So, I love plays like that, and the downside too.
So how important having a well-defined trading plan, and how can sticking to plan help maintaining the psychological resilience?
Say that again. I missed the last part of your question. I apologize. Go ahead.
How important having well-defined trading plan, and how can sticking to plan help maintaining psychological resilience?
Yeah, you have to have a plan, and your plan could change 1,000 times during a day. It's okay, but you got to contour the plan to your personality, or else it's not going to work. All right. Everybody's different. Nobody's the same. Don't think that my plan is the same as your plan, or the guy next door, the woman here. It's not. It's not. You have to have devise a plan that you're comfortable with, because there's enough distractions in this market. Even if that means missing a trade here and there, forget about it. Trade what you're comfortable with. Make your plan designed around your comfort level.
Got you. And how can traders effectively deal with losses and setback without letting them negatively affect their trading decisions?
All right, let me see that question. I don't know.
How can traders effectively deal with the losses?
Deal with losses and setbacks without letting them negatively affect their trading decisions. That is really difficult, okay? I like to give the example of tennis players. I give a couple of examples. Tennis players at a major tennis tournament, all right, where there's millions of dollars on a line if they go on to the next level, and they're in the semifinals, or they're in the quarterfinals, or they're in the semifinals. These players are like this. They don't deviate this way. They don't look peripherally. They're like this. If they look this way, it takes up a little energy. If they look that way, it takes up a little energy. If they shrug their shoulders and give poor body language, they take up more energy. It distracts you from your goal. If a horse is on a racetrack and the horse is fast as hell on a training track, okay, when they're running around a track, sets statistics, records, blah, blah, blah. They get in a race and the horse doesn't do anything. Well, some trainers will put what they call blinkers on a horse, blinders. What are blinders? They're flaps that prevent the horse from looking like that. All the horse does is concentrate on what's in front of the horse, all right, on the track. Well, that's how the mentality that traders have to have. They can't get distracted. They cannot allow themselves to get distracted. Of course, we all get distracted, but it's how you manage it. And the best way to manage it is a couple of those examples I gave you. Do not waste the energy. You're taking away for the next possible trade that you can make up the money that you just lost. Don't get distracted. Do the best you can. Here. Can't look that way. I'm not going to look down. I'm going to look straight ahead and stay focused.
That makes more sense. Thanks, Richie. Albert says, depth risk management. Before any trade, you have to be aware of risk and exit points. It's foolish to drive the car without proper experience or knowledge of the risk. Yeah. Thanks for that, Albert. Yeah.
Yep.
If there is any question, if you want to ask people in the room, please do ask in the chat, because we are coming to end of our session today. If not, I would ask your final quote from today, Richie. What's the golden nuggets from today's lesson?
Oh man, the golden nuggets is what they have shown in the last 2 days is just, it shows you how difficult this game could be. And it shows you not to get too comfortable with any one direction of the market. It shows you that, it's fine to be a swing. If you're a swing trader, you're a swing trader. If you're a day trader, you need to keep it really tight, okay? You don't want to keep it tight enough where you don't give yourself a chance to make money. You know that single entry trades is not the way to go. You don't want to have single entry trades. You don't want to use up all your ammunition in your initial entry. You need to save a little ammunition, okay? And if you're saving a little ammunition, you're good. If not, then you got a winning trade. That means you didn't get a chance to add. But if you're going to add, and you should, don't add and keep it tight. If you own something at 50, don't add at 49, okay? All right? Don't add at that. Add